I'm really excited for today's video because it feels like I get to shake the trees a little bit, kind of be a little bit against the grain. And that is, I want to talk a little bit about the use of retirement accounts for investors and for people that are trying to build their wealth. And I see this all the time. People are using their IRAs or using 401ks. And frankly, I think they're doing it somewhat inappropriately or misguided. And this might be one of those tricks or one of the things that you might see as clickbait of what the wealthy are doing. Well, you know what's interesting is that the wealthiest clients that I work with, their difference between their brokerage accounts and their retirement accounts is pretty stark, meaning they have a lot more money in their brokerage accounts or non-retirement accounts, and they have a very minimal amount in their retirement accounts. So what does that say to me? Is that they seem to think something about those accounts relative to maybe an alternative. And this likely could be because they were entrepreneurs and they sold their business and then they had a large payday or some sort of an exit. That's certainly possible. Or it could be that they just don't believe them. So this is what I want to talk a little bit about today, is the overuse of retirement accounts, i.e. 401ks and IRAs, for the use of wealth building. Now, don't get me wrong. I believe that those types of accounts can be great, but it comes with a caveat that there are some huge holes and some huge blind spots that exist if that is going to be your whole investment strategy to build financial security. So let me get into this. My experience is exactly what I just shared with you, that a lot of retirees or the wealthiest folks that I know have limited amounts of money in their IRAs, and they have most of their money in either brokerage accounts or other assets like life insurance or businesses or real estate or something like that. And again, very minimal in those retirement accounts. But on a practical level, I've seen this time and time and time again. And this is with a lot of baby boomers, because the baby boomers are really going to be that first generation where their entire retirement security was on their shoulders, meaning that most retirees today don't have much of a pension. Now, it's a little balanced as far as the pension thing, but most retirees today have a limited amount of pensions, whereas previous generations, that was kind of their only thing. And I think it comes from their previous generations in that you put away a 401k, you put away to this retirement thing, and you save and save and save in this because at some point in the future, you're gonna need that money. That's great. But it kind of comes from a little bit of a scarcity mindset that we've got to put so much money into that thing and we don't want to save into the other things because this thing is so important. And if we don't do it, we're going to be poor and we're going to be poor in retirement. So we weren't being, I don't think, creative enough when it comes to some of that long-term thinking in how we can manage our retirement assets and retirement income. So that's the first thing, is that a lot of people have focused a lot of their efforts and energy in investing into those retirement accounts, whether that's 401ks, SEP IRAs, things of that nature. So when it comes to my experience is that, I've worked with retirees for a lot of years, and now I'm shifting to a younger demographic, and I'm learning what the retirees had been doing for 30, 40 years, and how do we apply a different model to a younger demographic and a younger generation. So I want to map out the good, the bad, and the ugly. So let me start with the bad and the ugly first. So the bad is that retirees are putting too much money into retirement accounts, or people are saving too much into retirement accounts, and it doesn't allow them to save outside of that, and they're not saving other money. So one of the tenets that I work with my clients is, when we think about taxes, we don't want to just think about them from year to year. We want to think about them over the long haul. What we also want to consider is have a well-diversified tax strategy in retirement. So different income streams are going to be taxed at different levels. What I've experienced is that a lot of retirees, baby boomers that we're going to point to, which we can then track down to Gen X, millennials, and Gen Z, how we can learn from their quote unquote mistakes, is that we can start to think about tax strategy way beyond the retirement, where most people are thinking about retirement planning 3 to 5 years before retirement. We can think about this 20, 25, 30 years before that period of time. So the bad is that they don't have enough retirements, or they don't have enough savings outside of their retirement accounts in order to pay for life. So this is a very practical thing that I see time and time again. And frankly, it's a little unnerving and frankly, a little sad. So I had a client, they did a great job of saving. They saved upwards to 18, 20% of their income. They were putting it away, they were getting the match. So they had millions of dollars, frankly, in their retirement accounts when they retired. And they got to retire in their early, I think they were 60, 61 years old. So life was good. And they've never really had an income issue or a financial issue. But it didn't occur to them that when they were going through this period of time that they could, that this was a problem. Until when they retired, they started going on special trips. They started doing all these special things. And guess what? Every time they took a large distribution, it got taxed. So all of a sudden it was this tax cycle where they would take money out, it would get taxed, and then at the end of the year, they may have a shortfall in how much taxes they paid, so then they had to pay penalties, and then they had to do all these things. So in the end, it actually really hurt them. Another experience was client lives up in the mountains, been retired for a long time, had all of their savings in their retirement accounts, and they needed a new roof. Now, they don't live in an area that gets hail, so they don't have insurance claims that can provide a new roof in that capacity. So they had to pay about $30,000 to $40,000 in the new roof. Now, if you're taking $30,000 out of your retirement accounts, what does that ultimately be? What's the gross amount that you need to do if you're gonna be accounting for taxes? Well, it ends up being, gosh, $40,000, $45,000, something like that, in order to generate the net amount that they needed. So inevitably, you're gonna have to withhold taxes out of those distributions. So that's kind of the first thing is how are those income streams gonna be taxed? And if you're not saving outside of the IRA, then in retirement, what bucket of money are you gonna have to generate that type of income if you need it for special expenses? Things that happen along the way that aren't necessarily unplanned, but or surprising. They can happen and they can be planned for. And so that's a really big challenge. In addition to this, one of the challenges that we look at is, okay, we've got this bucket of money. We know that when it comes out, it's gonna get taxed. But what if we're generating income off of that money? Another client experience is similar situation. They needed an extra amount of money. They needed an extra $20,000. Well, their entire portfolio was generating the capital or the cash that they needed to live their normal life. And then all of a sudden they need an additional $20,000. Well, not only did they have to take over and above the $20,000 to make sure that they were withholding taxes and things like that, so the net amount was 20. They also had to blow up their retirement accounts in order to create that. So then that's kind of messing up the investment strategy because we're generating an income stream off of that amount. So that was a huge issue, and that can then make my job a lot harder because now I have to generate the same amount with less. Or do we have to adjust it? Do we have to go out on the risk ladder and potentially extend our risk that we're not super comfortable with to generate that additional income? That's another question that we need to have. So that's kind of the bad, is looking at it just purely from where we're saving. So one of the savings strategies that I think about is save in the right buckets and consider that. So I'm going to get to that here in a minute as far as some resolutions, because I'm not just going to leave you hanging with absolutely no alternatives or just no answers here. The ugly of this is this might be to solely save and build wealth through a retirement account might be the biggest tax on the middle class that we've ever seen. And it does it secretly. Now, we can get into all these conversations about how the Trump plan made it so ultra billionaires or ultra millionaires got this big savings because we increased the estate tax exemption, or the wealthy just get wealthier because of this. But this is actually an area that is so important, and maybe the secret to the whole thing is if you are the middle class, and that's a very loose term, and that's where you're saving, that's where you're putting a bulk of your money. Well, guess what? That transitions to the next generation very poorly. So under the new Trump rules, this goes back to 2018, if you inherit an IRA or a retirement account and you're not a spouse, you have to take those dollars out over 10 years. Now, why I say this is a big tax is because if you have to take those dollars out over the period of 10 years, well, then that adds to your income. As I mentioned before, distributions from an IRA, specifically an IRA or a traditional IRA or 401k, are going to be taxed at ordinary income levels. If you are the inheritor, so you're receiving the money, then you've got to take that money out over 10 years. And that's going to get added on top of any income that you've earned during your working year. And so if you are like a lot of the folks that I work with, millennials, Gen Xers, you're getting into that period of time where your parents are getting older, you're hitting your prime of your life. You're seeing that, we're seeing it, baby boomers getting into that age where they're starting to age and we're passing down assets by way of death. And this is a period of time where we're starting to see this really ramp up. And if you're in your prime working years, so let's just say you're a 45-year-old executive and you're making $300,000-$400,000 a year, and let's say your last parent passes away and you inherit $1 million account. Well, under the old rules, you could extend that distribution, so they're called required minimum distributions, and you've got to take them over. The old rules would allow you to take them over a really long period of time, which is your life. Now you have to take them over a 10-year period of time. And if you're making a bunch of money, that's at least $100,000 a year. So let's just say you're making $300,000. Well, now all of a sudden you're being taxed on $400,000. This does a whole slew of things. This will increase where your tax brackets are. It'll increase, you'll be exposed to all different types of taxes. You'll probably be excluded from certain tax benefits that you might otherwise get. And all of a sudden you're getting that $100,000 is getting taxed at a much higher level. So it doesn't really matter what tax bracket your parents were in. It really matters what tax bracket you're in. So we're not even, the calculus doesn't even really account for what tax bracket your parents were in and whether we should do Roth or not. Now we're thinking about the next generation. How are your children doing? And this is why I talk with my clients about, like older clients, like, what are your kids up to? What are they doing pretty well, or where are they at in life? And a lot of the times when I see these clients that have $1 million or more in their retirement accounts, and I know that their kids are doing well, then we might start having a conversation around, some tax strategies that might mitigate the tax penalty to the kids, because that's flat out what it is. These people worked really hard for this money, and now they're paying tax on the generational tax in the form of income tax. So really, really shocking thing that I think a lot of people don't consider when it comes to retirement planning and passing on and building legacy for their families. So that's a huge one. And this is again where I start to think about, if you've got different types of accounts out there, we have flexibility. And if you can get in front of it early enough, we can start to think about what are the alternatives. So I mentioned here, so this is kind of the good, is that if you get in front of it early, you can start creating a strategy around making sure that you have a strong, diversified tax strategy in retirement. That's number one. Number two, create an impact and legacy for future generations, and make sure that today you're actually getting some sort of a tax benefit if that's something that you're concerned about. And so that's another aspect, is that we don't want to just throw money into an account like a traditional IRA just because that's what we were told to do. That's just because, that's what my parents said. That's what all the literature online says. We've got to be a little bit more thoughtful, a little bit more intentional about how we're saving to retirement. And so again, when we look at what we're trying to do, is that there are options. And this is the cool thing, is that especially if you're in your late 40s or early 50s, we can start doing some tax planning strategy for retirement really quite easily, because at that point, the kids have gotten a little bit older. Your expenses is probably somewhat a little bit more normalized. When you've got young kids or kids that are, getting older, it's really hard to plan for some of this stuff, but you can kind of get a good sense of your baseline income needs. And so you can kind of figure out what you're going to need in retirement for income. But it is a little bit of an unknown, but we can do some rough math just to make sure that we're in the ballpark. And so we're saving to the right account. So there is some calculus that we can do to apply to your future self to say, hey, in retirement, we probably need about X number of dollars for, to live comfortably. Now, the question to you is, how do we do it? So I was just working with a client recently, and they had the same question. They have a fairly significant age gap between the two of them. So the husband is close to 60, the wife is in her late 40s, and they're trying to figure out if they've got enough to, for retirement. And they're trying to look to me to see what they need to do. And the beauty is that they do a great job of saving. So they save about 22% of their income. But what they were mostly doing is putting all that money into traditional IRAs. What we looked at is, how do we split that up? How do we keep that 22% effective savings rate on their income, but maybe think about it in a little bit different way? So what we're using a traditional IRA or a traditional 401k strategy, but we're also introducing brokerage accounts and Roth accounts. So this is another factor. And we've run this through both our tax planning strategy as well as our investments and some of the other things that we do here at 4 Points Wealth to make sure that they're overall going to be just as well. But now all of a sudden in retirement, they're going to have a much more effective tax and income strategy than they had before, because now they're going to have savings outside of their retirement. They're going to have a little bit of this, a little bit of that, and it's all going to come together and it's going to work together in a much more harmonious way. So that's the good, is that there is a solution. Now, what are some alternatives? So if you're the one that's out there, and even if you're close to 60 or close to retirement, there are some things that you can start to think about, even if you haven't felt like you've got enough outside of the 401k to plan, is you've got Roths. So Roth IRAs, Roth traditional or Roth 401ks can be awesome. I'm a big proponent of a Roth 401k. And the reason for that is that it doesn't have the same income restrictions and contribution restrictions that you have in a Roth IRA. And that's a beauty. So, and then on top of that, when you are making contributions to the Roth 401k inside your employer sponsored plan, most plans offer that match. Well, the match goes into the traditional 401k bucket. So that's a pre-tax dollar versus after-tax dollar. So in retirement, you've got a little bit of a bucket of money that would be the match. And then you have, you got really no tax benefit for that when you put it in there. But then you've got this Roth element that's going to be tax-free on the distributions if you've followed the basic rules of that. And so in retirement, you can have that income stream that's going to be tax-free because that money's already been taxed. You can use a brokerage account. So again, if we figure out, okay, your savings rate is 20%, let's call it. That's an awesome savings rate. That's a great target for a lot of clients that we work with. Is, okay, save 20%. Well, let's save 10% to retirement. Like that's good. That's a good amount to save to retirement. But then let's think about saving the other 10% in something that is outside of the retirement account. So this is where we introduce a brokerage account potentially, where we're making those monthly contributions to the brokerage account from your cash flow. So we're doing all that, putting those every month, making a systematic purchase of the funds. We got our brokerage account, and then the other alternative could be real estate, investing in real estate. This is another noble approach because you get some terrific tax benefits from depreciation. There's some great ways to get that. You can do what a lot of people call that mailbox type of income, where you're getting a rent check every single month. I've got a couple of clients that definitely love to do this. This is kind of their core investment strategy, is the real estate. And so there's a lot of things that we can do there that's really quite effective as well. And then another piece is going to use the cash value or permanent life insurance, where you build cash value for your life insurance and you can generate tax-free income using the cash value. This has been a tremendous vehicle for a lot of clients because it is one of those things that it can be a Roth IRA with a death benefit. So if something were to happen to you, you can pass on to your heirs tax-free money by way of the death benefit, or in retirement, you can generate that income on a tax-free basis. So these are some really good strategies to use in lieu of saving every one of your dollars into your retirement accounts, because frankly, the retirement accounts are overused and it's a little bit of an archaic way to think about building wealth and passing it on to the next generation.